Sticking to a trading plan can be pretty tough during normal market conditions, but when volatility hits the market, it can be even harder. It's easy to get suckered into taking a trade outside of your trading plan when the market makes large and quick moves in price, especially when you're short-term trading. And this can cause traders to get a worse fill and, even more importantly, plant the seeds of inconsistency. Even though the additional movement is likely to generate far more trading opportunities, somehow that fear of missing out in trading seizes control of the trader and their subsequent decisions become rash. So it short-circuits your usual decision-making process, leading to poor trading decisions. A dangerous and chaotic spiraling out of control can then take over as revenge trading shows up, and before you know it, you find yourself with a sizable loss on the day. Now, traders can live with one bad day, but when that bad day is due to your actions, not the market's, and the danger of having inconsistent trading becomes a habit, your trading career is at stake. Poor trading decisions such as this can have an impact outside of what you think is even possible. Now, here's a typical day for many traders. You thoroughly prepare for what you think could be an active session, given the importance of several economic releases, like the non-farm payroll or even the crude oil inventory. You specifically identify a number of possible scenarios and some entry prices that are likely to give you a great opportunity to make a healthy amount of ticks. Then you sit and you wait. So the numbers come out and the market reacts. Now, it's moving pretty quickly and it has a really good feel to it. Now, that's totally subjective. So the market sets up, you're calm and you're collected because your trading plan is the most important thing to you as a trader. And then it happens. As you're getting ready to pull the trigger on the trade, the market jumps a few ticks, pips, or points as several other traders take that trade ahead of you. That's all right, you're thinking, I can just get in when the price has a pullback. But the pullback is just a little bit too shallow for you to get your fill. So maybe you trade support and resistance, or you're using a moving average as your setup zone. Now the market starts to move nicely in the direction of the trade that you missed. Well, the trouble is that the fear of missing out now starts to take control, and it's a pretty powerful motivator. It can also be powerful in blinding a trader to the reality of the actions that they're about to take. So you pounce on the runaway beast, and all of a sudden it stops and reverses. And this is when it dawns on a trader that they only managed to take the trade because the market had already started losing some steam and the entry was poor. Now, if you ignore the day trading rule, which is don't chase trades, the most dangerous outcome is to be rewarded and end up with a highly profitable trade. So even if this only happens in a small number of trades, it's unlikely that this will be at the forefront of your mind when those strong fear of missing out emotions are motivating you to take the trade. So if you get these poor trading decisions reinforced by the occasional positive outcome, it's unlikely that you're going to learn any of the important lessons of why you don't chase a trade. Well, to start with, the market doesn't care where you enter. So if you get in at a much worse price than you planned for, well, your risk may have increased dramatically. But where you're wrong remains the same. And so your stop has to increase in size. So if your profit potential is still good and you have the flexibility to reduce the size of the trade to normalize your risk, well, then a trade could still work. But this is all too often not the way that things happen. Apart from the added level of price risk to see if the trade's going to work, by getting in after the market has already made a thrust and before it's had a chance to pull back, you are increasing the risk that it's going to move against you and move against you fast. Now, bear in mind that the reason that you chase the trade is that you're becoming emotional in the first place. And it's easy to see that a sharp move against you right after you entered the trade is only likely to intensify your emotions. Psychologically, chasing trades can be extremely damaging. Additionally, when they do happen to go right, the trouble is that you will see a decrease in the level of profit potential. Now remember, the market didn't care where you entered, and it's going to go where it wants to go regardless. So if you've taken a trade closer to its destination, your profit potential is diminished. So in terms of how you should approach potential trades in order to guard against chasing them, I want you to think of how a cat goes after its prize. Well, a cat is a natural and effective hunter. It identifies its prey, it stalks its prey, and then it waits for the best moment to pounce. It either pounces or it passes up on the opportunity and returns to other business. Now, if you've ever watched a cat stalk its prey with absolute intent and focus only to pass at the last minute, it's pretty fascinating to watch. So there's no question that chasing trades is a poor trading decision. So here are a few more tips to help you avoid it like the plague. Number one, try to be focused when your trades show up. If you're able to set up audible alerts on your platform, then do that. Avoid distractions when you're scheduled to trade and set up your trading environment to take this into account. Second, if you find that you're often missing trade setups by a small margin, ask yourself if your entry plan needs revising or whether you might add a secondary entry plan if you miss the first chance to take a trade. Third, ask yourself the question of whether you're being too impulsive because of the fear of missing out. Awareness is that first step to remedy that situation. Number four, as part of your trade plan, you might want to consider giving yourself a certain amount of tick tolerance for your entries so you don't have to get your entry price 100% right every single time. The day trading rule to not chase trades is probably not one where the importance is going to be apparent every single time that you trade. It is, however, going to be crucial when the markets are moving fast. As important as it is to not miss your planned trades, not chasing trades is a rule that might just save you a substantial number of ticks.